So when the final numbers for Q3 2025 U.S. GDP landed, the financial world didn't just blink it. It did a complete double take.
It really did.
The headline figure just flashed across every screen. A massive 4.3% annualized growth rate. And, I mean, this isn't just a good number, it's spectacular.
That's a blockbuster number, absolutely.
But it arrived in this economic climate that was just defined by contradictions, right? You have interest rates that are stubbornly high, global volatility is, a constant feature, and trade policy was so unpredictable that I think I read somewhere that supply chain managers were taking up meditation just to cope.
I believe it. And that context is exactly why this 4.3% figure immediately triggered, well, both awe and just a huge amount of skepticism.
Right.
It suggested that the U.S. economy had found some kind of hidden reserve of energy, something fundamentally new was powering its momentum.
A new gear, maybe?
A new gear, exactly. But as is so often the case with these big celebratory headlines, there is a crucial statistical subtlety that, it requires us to dig deep almost immediately.
Okay, so let's start right there with that essential statistical foundation. What exactly does 4.3% annualized really mean in this context?
It means we're looking at momentum, not endurance. That's the key distinction. The 4.3% figure is derived from the growth that was observed over just 3 months, July, August, and September, and then it's mathematically projected across a full calendar year.
So it's a snapshot, a very fast snapshot.
It captures the speed of that specific quarter, that's all. If we zoom out to the metric that gives us a much clearer picture of the economy's underlying, its structural health, the year-over-year growth, the picture is far more sober.
And what was that number?
That number was hovering closer to a much more modest 2.3%.
Okay, so 2.3% year over year, that sounds consistent with an economy that's managing high interest rates. It's respectable.
It's respectable. It's what you'd expect.
But 4.3% for the quarter is a different beast entirely. That's an acceleration that just demands an explanation.
Precisely. And that acceleration, that massive gap between the 2.3% baseline and the 4.3% sprint, that is the core of our deep dive today.
Okay.
Because what happened in Q3 was frankly extraordinary. The economy didn't suddenly get a broad traditional recovery. It didn't suddenly see housing construction take off or, small manufacturing firms hiring en masse.
No, none of that was happening.
Instead, what we see in the data is evidence that the economy bolted a sophisticated, incredibly powerful jet engine onto a single, very narrow sector. And that one sector took off with a velocity that compensated for weakness almost everywhere else.
And we are definitely talking about artificial intelligence, aren't we?
We are, the AI engine. And that leads directly to our mission here today. We need to unpack the source material we've gathered to understand exactly what powered that 4.3% surge and, critically, who benefited from it.
Right.
We'll also analyze the historical fragility and the structural risks that are hidden inside that massive number. And finally, we have to assess how external policy decisions, particularly the expansion of tariffs, contributed to this highly split, this bifurcated economic reality.
And what they meant for the rest of the world. I saw some fascinating notes on countries like China and India.
Oh, yes. The global implications are surprising and really, really important to understand.
That sounds like a journey from a headline celebration to a deep structural critique. Okay, let's unpack this. So let's start with the engine itself. AI. We've all been hearing the promises of AI for years, but the data for 2025, and especially for Q3, it paints a picture where AI wasn't just a driver of growth. It seems like it was the primary, maybe even the only, source of net forward motion.
You are absolutely right. I mean, it's hard to overstate this. What the research and the analyst reports all show is a phenomenon of complete economic dominance by one single spending stream. In 2025, AI-related capital expenditures became the single most important factor pushing U.S. GDP forward.
Okay, let's be really clear for you, the listener. When we say AI-related capital expenditures, this isn't just software or, market valuations on the stock market. We're talking about physical spending, right?
That's a vital distinction to make. We're talking about physical goods and infrastructure. This includes the money spent on constructing these colossal data centers you see popping up.
The ones that need their own power plants.
Practically. It also includes the GPUs and the specialized processing chips themselves, the NVIDIA chips everyone talks about. And then you have the necessary cooling systems, the power systems, and all the underlying cloud infrastructure required to run these large language models. This physical investment, this CapEx, capital expenditure, that is what gets counted directly as private investment in the GDP calculation.
And the scale of the imbalance here is what makes that 4.3% number so, I guess, misleadingly strong.
It is historically extraordinary. I mean, economists who study this kind of concentration, they note that by conventional measures, AI represents only about 4% of the overall U.S. economy, maybe even less.
4%, so a tiny slice.
A very tiny slice. Yet the consensus among the economists analyzing the national accounts is that this niche sector accounts for somewhere between 50% and a staggering 90% of total U.S. GDP growth in 2025.
Wait, can we just pause on that? 50 to 90% of all new growth in a $27 trillion economy is coming from a sector that makes up just 4% of it.
That's what the data is telling us. It's almost beyond comprehension. We're talking about one small, highly specialized corner of the economy being responsible for virtually all the forward movement.
Doesn't that make the whole system incredibly dependent? I mean, fragile?
It creates what some are now calling an economic singularity. The fate of the entire system now hinges on the continued health and, frankly, the continued frantic spending within this single niche. And that spending has been financed relentlessly. It's a true flood of financial fuel.
Okay, so give us the scale of that financing. Where is all this money coming from?
The financing is really twofold. Firstly, it's coming from massive internal corporate commitments. The reports we've looked at highlight that there is a colossal amount of new compute capacity. We're talking potentially $1 trillion real scheduled to come online in just 3 years.
$1 trillion?
$1 trillion. And this isn't just a plan on a whiteboard. This is money that's already been committed by major corporations to data center construction and hardware purchases.
And the second source?
The second is intense venture funding. We've seen over $200 billion in AI-focused venture capital injected into the system just through Q3 of 2025 alone.
And who is the main recipient of all this capital? Where does it end up?
The vast majority of this capital is flowing to a handful of companies, what are popularly known as the hyperscalers.
So for our listener, that's basically the mega cloud providers, right?
Yeah.
Amazon's AWS, Google Cloud, Microsoft Azure.
Exactly. Those are the big three. They are seeing relentless, almost insatiable demand for computational power from thousands of startups and established enterprises that are all trying to integrate AI into their businesses.
So they're basically selling shovels in a gold rush.
The most expensive shovels ever made. And here's the key loop. They take those massive profits and they immediately turn them back into building more capacity, more data centers, more servers, more specialized chips.
So I need to step in here and make sure we connect the jargon to the reality for everyone listening. When we talk about these hyperscalers spending their profits on CapEx, which is capital expenditure, we mean they are essentially buying physical equipment.
Yeah.
But why is their CapEx so disproportionately powerful for the GDP calculation compared to, say, a traditional manufacturer buying a new fleet of trucks?
That's a critical question because for GDP, on paper, investment is investment regardless of the sector. But the sheer scale and the velocity of the hyperscalers spending in 2025 is what's completely unique.
How so?
Well, traditional manufacturers are highly sensitive to high interest rates. The Fed raises rates, it becomes more expensive to get a loan to finance new equipment, so they pull back.
Right. That's how monetary policy is supposed to work.
It's the whole point. The hyperscalers, however, are capital rich. They're funding their CapEx internally from profits or through cheap equity. They're essentially bypassing the high-rate environment the Fed created. This makes their spending stream an unstoppable economic force that just ignored the traditional macroeconomic brakes.
Which is why that analogy works so well. The U.S. economy in 2025 is literally standing on GPUs.
It is. The phrase really sticks because it implies both immense height and, immense precarity.
Well, let's quantify this dominance a bit more because the data suggests AI was acting as the only engine for the majority of the year, not just in that spectacular third quarter.
Absolutely. Let's look at the first half of 2025. Total GDP growth was pretty modest. It was hovering around 1.2% annualized. Not bad, but not great.
Right.
But what we found when we dug into the underlying data is remarkable. Nearly all of it, a staggering 92% of that growth, came directly from AI-related investment.
Wow.
That contributed 1.1 percentage points of the 1.2% total.
Wait, hold on a second. If 92% of the growth in the first 6 months of the year was AI related, that means without AI, the U.S. economy would have grown by, what, 0.1%? That's virtually flat.
It would have been flirting with stagnation, if not outright contraction, especially when you consider the interest rate environment.
So this is why the AI engine is not just an interesting story. It was basically the necessary life support for the national accounts.
That's a perfect way to put it. It provided the only reliable lift when all the traditional drivers were being suppressed by high borrowing costs and, as we'll discuss later, a lot of trade uncertainty.
And when we look specifically at that massive 4.3% annualized headline number for Q3, AI infrastructure was still driving a huge portion of that growth.
It was. It contributed between zero point 0.5 and 1.00 percentage points. So even in a quarter that saw a broader acceleration, AI was still responsible for somewhere between a tenth and a quarter of that massive number. This continuous, relentless CapEx stream provided crucial ballast.
Ballast is exactly the right word, because Q3 wasn't exactly sunshine and rainbows everywhere else in the economy, was it?
Not at all. Q3 was marked by concurrent weakness in several really important traditional sectors. Housing remained under severe pressure from high rates.
Right.
Manufacturing was dealing with trade friction and inventory adjustments, and inventories themselves were contracting, which is typically a drag on growth. AI investment was the counterweight, the single largest positive shock that allowed the headline to look so strong and offset all that underlying softness.
That structural split, the explosion in AI, contrasting with the stagnation or contraction everywhere else, that really is the economic story of 2025. It suggests that the macroeconomic environment isn't unified anymore.
It confirms the existence of two parallel economies, and the full-year projection underscores this dependency. Overall growth for 2025 is expected to land around 2.5%. Based on the momentum and the spending pipelines we discussed, AI investment is estimated to account for half to nearly all of that total expansion.
The entire system is leveraged on this one single investment stream.
It is.
So to truly decode that 4.3%, we really need to get into the anatomy of GDP, the expenditure framework. So for everyone listening, that's GDP equals consumption, C, plus investment, I, plus government spending, G, plus net exports, which is X minus M. Let's break down who bought the growth in Q3.
Absolutely. The detailed decomposition of the 4.3% growth is illuminating. It shows exactly where the primary forces came from.
Let's start with C, consumer spending, which is always the bedrock of the U.S. economy. How did it look?
Consumer spending was indeed still the main engine. It contributed a very substantial 2.39 percentage points to that 4.3% growth.
So more than half of the growth came from consumer.
More than half. This reflects an annualized growth rate of 3.5% in consumption, which is undeniably robust. Consumption remains nearly 70% of the U.S. economy, and in Q3, spending was strong across both goods and services. Travel, healthcare, high-end discretionary items were all up.
But this is where the conversation gets really interesting, I think. That strong consumer spending doesn't sound like an economy that's under pressure from high rates. And it seems to link directly back to the AI investment and who is participating in that boom.
Exactly. The key caveat that the analysis highlights is that this continued spending wasn't broad-based. It was heavily concentrated among wealthier households.
Okay.
These are the households that were buoyed by significant stock market gains that were themselves highly concentrated in the very AI-heavy firms, the Magnificent Seven.
So we have a macroeconomic feedback loop here. AI investment drives tech stocks up. High-income people who own those stocks feel richer. That's the wealth effect we hear about. They then go out and spend freely, and that spending provides two-thirds of the GDP boost.
It is a self-reinforcing, but as you can imagine, ultimately a potentially fragile loop. Those major tech firms, through their rising valuations, effectively acted as a macroeconomic stabilizer. They generated a wealth effect that allowed affluent households to keep spending on discretionary services, offsetting any hesitancy felt by the majority of consumers.
Okay, let's move to net exports, the XM part of the equation. Trade usually acts as a massive anchor on U.S. GDP because we import so much more than we export. But in Q3, the sources show this provided an enormous, almost silent boost, 1.59 percentage points. I mean, that is almost unheard of.
It was a massive unexpected contributor. It accounted for nearly a third of the headline growth. What happened was a convergence of two powerful and related forces. First, exports surged by a strong 8.8%. So U.S. goods and services were in high global demand.
Okay, that's good news.
It is. But second, and more importantly for the calculation, imports fell dramatically by 4.7%.
Can you break down for the listener why falling imports are a boost to GDP? It feels completely counterintuitive.
It's a mechanical trick of the formula. And it's really important to get this. Remember, GDP measures the total value of goods and services produced within a country.
Right. Domestic production.
Since imports are produced somewhere else, they are subtracted from the total calculation to ensure we only count what we make here. So, when imports drop suddenly, the trade deficit narrows, and that narrowing deficit mechanically adds significant unexpected momentum to the headline growth figure.
Even if domestic production hasn't actually changed at all.
Exactly. And we'll explore why imports fell so sharply in our discussion on tariffs, because that mechanical boost has a very real cost.
Got it. So we have consumption driving about 2/3 and net exports driving almost 1/3. That accounts for almost 4 percentage points of the 4.3%. We're just left with government spending, G, and private investment, IBR.
Right. Government spending was a modest positive tailwind, contributing 0.39 percentage points, primarily driven by federal defense outlays and some recovering state and local spending. Now, private investment, is where the fundamental contradiction of 2025 is just perfectly encapsulated.
The aggregate number for private investment was a net negative 0.02 percentage points, so effectively zero. But you're telling me that that zero is the most misleading number in the entire report.
It is the ultimate mask. That zero is the result of two completely opposed forces canceling each other out perfectly. On one side, you have traditional capital formation things like residential construction, new commercial structures, and inventory accumulation.
The stuff the old economy is built on.
Precisely, and all of that slowed dramatically, showing strong negative contributions driven down by high interest rates. Construction, in particular, suffered immensely because financing was suddenly prohibitive for builders.
And on the other side of that equation,
On the other side, as we've discussed, the AI capital expenditure exploded. The massive rate-insensitive investment in GPUs, data centers, and specialized equipment from the hyperscalers was just enough to exactly offset the decline in every other type of investment, from housing starts to factory upgrades.
so the overall economic policy of high interest rates was successfully slowing the traditional economy, the one sensitive to borrowing costs, but it was absolutely irrelevant to the capital-rich AI sector. The I component of GDP is basically proof positive of the two parallel economies operating simultaneously.
It shows that traditional monetary policy was bifurcated in its effect. It put a tight brake on the old economy, but the new AI-powered economy, funded by internal profits, venture capital, and equity markets, was completely immune. This level of concentration, where a single stream of capex masks the profound weakness across housing and traditional construction, it's just unprecedented.
Okay, so this spending, this enormous investment, it has to be geared toward producing something valuable, beyond just a demand for more chips. Let's shift our focus from the spending that generated the GDP figure to the results, the productivity payoff. Is this just a spending spree, or is it actually leading to a true economic transformation?
This is where we move from the short-term financial mechanics to the long-term potential for, well, a true golden age of economic growth. AI is fundamentally reshaping how work is done, and this shift is starting to yield measurable, tangible productivity gains that move beyond just anecdotes.
So what are the general metrics showing in terms of efficiency gains across different sectors? What does the data say?
The data coming out of businesses that have adopted AI at scale is incredibly compelling. They are reporting productivity gains that range from 40% to 80% in roles that are AI-assisted.
40 to 80%, that's
Yeah.
huge. What kind of roles are we talking about?
Things like code generation for software developers, basic legal document review, and a lot of customer service applications. It's also affecting the individual worker directly. Analysis indicates that employees are saving, on average, 2.5 hours per day because AI tools are handling the routine, repetitive tasks.
Saving 2.5 hours a day is immense. If you translate that time back into more creative or complex work, that should significantly reduce costs for firms, right?
It translates directly to the bottom line. It shows up as a reduction in operating costs, which have fallen by a reported 28% to 42% in firms that have aggressively adopted these AI tools.
And these cost savings and time efficiencies, they don't just stay within the realm of tech, right? They're beginning to ripple outward.
That's the crucial part. They are.
So let's make these abstract gains real by looking at some specific sectors. Where are these efficiency gains showing up outside of a Silicon Valley tech lab?
We see substantial, measurable improvements in traditional, often overlooked areas of the economy. Manufacturing efficiency, for example, is up approximately 25%.
And how is that happening?
It's driven by things like predictive maintenance on machinery, so you fix things before they break. It's optimizing supply chain logistics, using large language models to predict demand and route shipments. And it's automating quality control on assembly lines with computer vision.
That 25% is a significant jump for an industry that's often characterized by slow, incremental change. What about the service and financial side of the economy?
In financial institutions, the use of AI for complex pattern detection has led to improved fraud detection by about 45%. This is reducing massive losses from financial crime. So this isn't just about efficiency, it's about protecting capital.
And in healthcare, that's an area everyone is watching.
Critically, in healthcare, which is notoriously slow to adopt new technology, diagnostics accuracy is up by approximately 23%. This is really important because it suggests AI is moving beyond simple administrative tasks into high-value, life-critical applications like reading medical scans.
When you look at those numbers, 40–80% productivity gains, 2.5 hours saved per employee, 25% efficiency in manufacturing. It fully explains the incredible financial excitement and the capex we saw driving Q3. This isn't just hype. This is real economic power being unleashed.
It sets the stage for a dramatic global reordering. Looking ahead, AI is projected to add a colossal $15.7 trillion to world GDP by 2030. And crucially for our conversation about the U.S. economy and that 4.3% surge, the U.S. is currently positioned to capture a disproportionate share of that massive economic value.
Why is that?
Largely because of the early, dominant, and concentrated investment in the core infrastructure we discussed in the first section. The U.S. is building the foundation that the rest of the world will likely rent.
Okay, that is the glittering high-octane side of the economy, the AI jet engine. Now with you to required balancing act, because the research is very, very clear. This highly concentrated growth model, while powerful, comes with serious structural risks. We need to look at what you call the four shadows beneath the boom.
We must look at the fragility. The sheer brilliance of that 4.3% headline blinds many to the four major vulnerabilities that underpin this entire structure.
Let's start with the most immediate risk, overconcentration risk. If the economy is truly standing on GPUs, what happens if that AI capex suddenly slows down?
This is the single point of failure in the national growth strategy. If investment in AI were to slow down by even a moderate amount, say 10% to 20%, economists are clear. The U.S. could slip almost immediately into a recession.
Why so quickly?
Because the underlying fragility we saw being masked in Q3, the weakness in housing, manufacturing, traditional investment, would be instantly exposed. No other sector is currently strong enough or large enough to compensate for a sudden drop in AI capex. The ballast would be gone.
So it's not a gradual slowdown then. It's more like a cliff edge scenario. That leads us directly to the financial risk. This level of hyperinvestment, driven by venture capital and future promises, always raises the specter of a bubble dynamic.
That's the second shadow. And what has emerged is a highly circular, self-sustaining financial ecosystem that can maintain its momentum on belief, even if the underlying operational returns are still, nascent.
Walk us through that cycle.
Okay. AI startups raise massive amounts of capital from venture capitalists, truly enormous rounds of funding. They then immediately spend that capital on cloud compute services, which means they are essentially renting GPUs from the hyperscalers.
So that money flows directly from the VCs through the startup to the hyperscalers.
Exactly. The hyperscalers, Amazon, Google, Microsoft, they record that as massive revenue, which leads to colossal profits. They then immediately reinvest those profits into building more data centers and buying more GPUs.
I see the loop.
Meanwhile, the VCs look at the rising revenue of the hyperscalers and the increasing usage from the startups, and they decide that the startups must be incredibly valuable, so they mark up their valuations for the next funding round.
It's capital churning on itself. Revenue fueling capex, which fuels valuation, which fuels the next round of capital. The circle is complete, but where's the real, tangible value creation for the broad economy in that loop?
That is the central risk. The guaranteed profitability and the spillover into the broad economy beyond the tech giants are not yet proven or guaranteed. If investors suddenly demand a clear path to sustained external profitability and start to slow the funding, the entire circular ecosystem could seize up very, very quickly.
And that zero point 0.5 to 1.2 over percentage point contribution to GDP from CapEx instantly disappears.
It vanishes, and the entire economy slows down hard.
The third shadow you mentioned is deeply physical and logistical.
Right.
The energy and infrastructure strain. This boom is entirely digital on the surface, but it relies on massive physical resources.
This is perhaps the most underestimated vulnerability because it has immediate, real-world consequences for everyone, not just for investors. The demand for electricity from these proliferating data centers is exploding.
How much are we talking about?
Current projections suggest that data centers could triple U.S. electricity demand by 2030. And in specific regions, the demand is growing far, far faster than utilities can handle.
What does tripling the country's electricity demand actually mean for the average person and the average business?
Well, it puts severe strain on our existing power grids, which were simply not built to handle this type of continuous exponential load growth. The consequences are manifold. You have stressed infrastructure, a higher risk of brownouts or blackouts, and critically, rising utility costs for everyone.
For households, for small businesses, for other manufacturers?
Everyone, because utilities have to build massive, expensive new capacity very quickly, and those costs get passed on to all ratepayers.
And this creates political friction at the local level.
Hmm.
I have imagined that few communities are enthusiastic about having a massive energy-hogging data center built next door.
Precisely. We are seeing significant local political resistance. NIMBYism, not in my backyard, against data center construction because of the strain on local infrastructure and the environmental impact. So AI's success creates a negative externality. It creates a competition for power, which raises the cost of living and doing business for everyone else, forcing the broader economy to absorb the side effects of the tech boom.
That leads us directly to the fourth and final shadow: inequality and displacement. If AI is saving people 2.5 hours a day, that implies a lot of jobs are changing or maybe disappearing entirely.
And this is the human cost. While the AI and tech sectors are seeing a boom in high-wage specialized jobs for engineers and data scientists, that's the upward arm of the economy. Automation is concurrently displacing workers elsewhere. We see massive potential displacement in logistics, customer service, basic coding, and even mid-level administrative roles.
And the data shows this isn't just a future threat. It's already happening in the labor market, right?
It does. The official unemployment rate has already crept up to 4.4%. But the structural shift is more concerning than just that headline number. The research indicates a real erosion of confidence among non-investor households, the people who rely solely on wages, not stock portfolios.
And what are they seeing?
They see the spectacular headlines about the booming economy and the soaring stock market, but they're feeling the threat of automation and higher utility prices simultaneously. This growing structural anxiety is the first link that leads us directly to the concept of the K-shaped economy.
That is the essential pivot. We've established that the 4.3% GDP number is misleadingly fast and dangerously concentrated. And Paul Krugman, among others, looked at this and delivered a powerful, sobering counterpoint. The economy is fast, yes, but it is fundamentally broken. It slipped decisively into a K-shaped trajectory.
That's the core of his critique in late 2025. The GDP headline is a measure of speed and aggregate value, but the K-shape is a measure of participation and distribution, and participation is shrinking. The benefits of that 4.3% growth were highly, highly selective.
Let's define those two distinct arms of the K that Krugman describes for everyone listening.
Okay, the upward arm of the K is soaring. This is your stockholders, high-income professionals, asset owners, and the employees of the hyperscalers and the Magnificent Seven. These are the people riding the booming markets fueled by AI investment. They are the ones with the wealth effects that are contributing to the vigorous consumer spending we saw in Q3. Their trajectory is accelerating upwards.
And the downward arm.
The downward arm is stuck, or it's sliding backward. This group includes service workers, many low-wage manufacturing employees, minority groups, and any household whose income depends entirely on predictable, stable paychecks, not on portfolios. Their fortunes are tied to a frozen labor market and stagnant real wages, exacerbated by high prices driven by the policy environment.
Krugman's most provocative point, I think, is that this economic split isn't just an unfortunate outcome of technology. He argues it's a deliberate choice.
He is insistent on this point. He rejects what he calls lazy cynicism, the idea that technology must create inequality. He views this divergence not as some market inevitability, but as a policy outcome. The choices made by policymakers and regulators, particularly regarding trade and labor, are actively contributing to this widening gap between the two arms of the K.
To really understand the current disappointment, we have to look at the immediate past for contrast. The 2021-2023 recovery offers a powerful, almost historical counterexample to the K-shape we are seeing now.
That earlier period is viewed by many economists as a rare moment of economic egalitarianism in modern American history. Krugman even compared it to a modern echo of the 1940s Great Compression, which was the historical period when income inequality significantly narrowed in the U.S.
And how is that achieved back then, in 2021 to 2023?
It was achieved because full employment policies, massive stimulus, and pandemic-era labor shortages led to an extremely tight labor market. Power shifted for a time toward labor and away from capital.
And the data from that time proves this compression was real. It wasn't just a theory.
The data is striding. For a significant period, low-wage workers saw their real wage growth outpace that of high-wage earners. Research cited in the reports showed that at the peak of this egalitarian moment, around September 2022, the bottom quartile of earners saw wage growth accelerate to about 7.75% annually.
And how does that compare to the top earners at that same time?
Top earners saw growth of around 4%. Now think about the implications of that. For the first time in decades, the economy was genuinely rewarding labor at the bottom faster than it was rewarding wealth at the top. It was a fundamentally different and a much more inclusive economic dynamic than the wealth effects that were driving Q3 2025.
So if that was the Great Compression moment, when did the lines cross back? When did the K re-emerge and that egalitarian moment end?
The reversal began quietly in late 2024, and then it accelerated sharply into 2025. The pattern inverted completely. High-paid workers, your data scientists, executives, AI engineers, they saw their wage growth accelerate, fueled by the intense demand for AI talent. Meanwhile, wage gains for low-paid workers slowed dramatically, barely keeping pace with inflation. The blue line of low wages flattened out, and the red line of high wages just climbed rapidly.
And this coincided with the labor market going frozen, as you mentioned earlier. What does that phrase, frozen labor market, really tell us?
It means the high demand and the dynamism that had empowered workers just disappeared. Overall, unemployment began to climb, rising from the healthy 4.0% levels to about 4.6% by mid-2025. More critically, the unemployment rate for marginalized groups, particularly Black unemployment, increased sharply, which is always the clearest signal that job insecurity is hitting those with the fewest safety nets first.
This suggests it wasn't just about the number of jobs available, but the quality of those jobs and the structural power dynamic.
Absolutely. Gallup polling at the time showed a growing pessimism specifically about job quality and future prospects, which far outweighed pessimism about the sheer availability of work. When the market freezes, when job openings dry up, and mass hiring stocks power reverts instantly to the employers.
And workers lose their leverage.
They lack the leverage or the savings to push for higher wages, demand better benefits, or easily switch jobs for higher pay.
That lack of worker leverage is the critical mechanism for deepening the K-shape. It allows the upward arm to accelerate unimpeded, while the downward arm is just stuck in place, unable to benefit from the overall economic growth.
And this leads us directly back to that celebrated 4.3% GDP print of Q3 2025. When you look at that number through the lens of the K-shaped economy, the triumph starts looking extremely specific and, frankly, highly exclusionary.
So the crucial interpretation of that 4.3% surge, then, is that the massive consumer spending component, that 2.39 percentage point contribution, was primarily driven by those wealth effects.
That's the interpretation. It was asset owners feeling wealthy due to the soaring stock market fueled by the AI boom, spending freely on discretionary services like high-end travel and specialized healthcare. That spending looks magnificent in the GDP calculation. It makes the consumer appear strong, but it simply doesn't reflect the reality for the downward arm of the K.
Who were simultaneously watching their real wages flatten against rising utility costs.
Exactly.
So the U.S. economy can achieve these spectacular headline numbers, proving its immense vitality, even while millions of households are just treading water, or worse, losing ground to inflation and stagnant job quality.
It is the ultimate macro mirage. The growth engine was running incredibly hot and fast, but it was, as one analyst put it, unevenly lubricated. The benefits lubricated investment portfolios and equity markets, but they failed to lubricate the broader labor market or the manufacturing sector, reinforcing that fundamental split.
So we have to ask the causality question that Krugman raised. He rejects the idea that this divergence was inevitable. What policy choices does he point to as the central controllable culprit for freezing the labor market and deepening decay?
He points directly to policy-driven uncertainty stemming from trade policy. The continuous, erratic tariff threats issued by the administration, coupled with shifting lists of economic enemies and unpredictable trade actions, created an environment where businesses became profoundly hesitant to expand payrolls or invest in long-term, non-AI capacity.
Why does that kind of uncertainty hit hiring so much harder than it hits, say, AI capex?
Because payroll is a long-term commitment, especially for low-wage positions that require training and incur compliance costs. When firms lack clarity on their future input costs, their market access, or their supply chain stability, all of which were undermined by the trade policy, they opt to wait. They delay hiring decisions, they rely on existing staff, or they just implement hiring freezes.
And that lack of hiring dynamism hits low-wage and marginal workers first and hardest.
It does, exacerbating the shift in power back toward employers and locking that K-shape in place.
So the very trade policies that were intended to create jobs and protect certain industries ended up creating massive uncertainty that stalled hiring, which in turn depressed wage growth for those at the bottom. The K-shape becomes an unintended yet predictable consequence of policy choices.
That's the critical link. The tariffs were intended as a shield, but they created a friction that directly impacted the lowest wage workers. And that is a perfect transition to our next section. Analyzing the tariffs not just as a political tool, but as a major dual-sided economic shockwave that simultaneously boosted the GDP calculation while dragging down overall economic growth in 2025.
Right, tariffs are often sold as economic shields, these necessary protective barriers. But the research suggests that in 2025, they acted more like friction or even a chaotic shockwave, creating statistical illusions while causing long-term structural damage.
The experience in 2025 amidst the expansion of the tariff regime, which included the use of IEPA authority on major trading partners like China, Canada, and Mexico, and Section 232 duties on basic goods like steel, aluminum, and autos, is a textbook example of this duality.
And what's the consensus from economists on this?
The consensus among independent economists is clear. The tariffs acted as a net drag on U.S. GDP for the full year, despite the temporary statistical boost we saw in Q3.
Okay, let's start with a short-term illusion, the statistical mirage that briefly made the 4.3% look so healthy.
The most important mechanism is the trade deficit effect, which was dramatically visible in Q3. As we established in the GDP equation, imports are subtracted. Tariffs caused imports to drop sharply by that 4.7% because they made foreign goods instantly more expensive or uncertain to source.
And because imports fell, the GDP calculation got a massive artificial lift.
Exactly. That 4.7% fall in imports was the primary reason net exports contributed a striking 1.59 percentage points to the 4.3% annualized growth rate. We got a massive GDP boost simply because we bought less foreign stuff, which is a measure of reduced activity, not increased domestic competitiveness.
And was that reduction in imports stable or structural? Was it a permanent shift?
Not at all. And that's the key. Much of the import decline was due to what economists call the pull-forward effect. It's a sugar high.
A sugar high. Explain that.
Firms, anticipating that future tariff hikes were imminent or that policy would shift again, rushed to import and stock their inventories before the duties hit. This caused a spike in imports in Q4 of 2024 and Q1 of 2025, followed by the inevitable sharp pullback in Q3 once those inventories were fully stocked.
So it's basically borrowing growth from the future. And when the pull-forward effect runs out,
the mechanical boost disappears, leaving only the friction and the cost behind.
Were there other forces that masked the longer-term drag from the tariffs?
Yes, there were two important offsets. First, tariff revenues provided a kind of fiscal cushioning. Tariffs generated roughly $143 billion in revenue in 2025 alone.
That's a huge number.
It is functionally the largest effective tax increase since 1993. Now, while this is an inefficient, distortionary tax, the revenue was collected and used for various federal ends, which temporarily supported government demand or reduced the deficit, and that provided some economic cushioning.
And the second offset, of course, was the AI jet engine we keep coming back to.
The relentless, rate-insensitive investment in technology provided a massive economic mask. It contributed that 0.5 percentage points to Q3 growth, offsetting the damage in manufacturing and traditional capital investment. Without that specific technological boom, the trade damage would have been far more obvious. It likely would have led to outright contraction or a recessionary feel for most of the year.
So to see the true unmasked cost, we have to look back to the beginning of the year. The research points to early warning signs appearing in Q1 of 2025, before the AI capex had fully accelerated.
That's right. The U.S. economy actually contracted in Q1 2025 by roughly 0.6%. That was the first quarterly decline since 2022. And tariff uncertainty was a central culprit.
How so?
Export volumes in tariff-affected sectors, everything from agricultural goods to specialized equipment, plunged nearly 18% as foreign buyers delayed purchases amid the political tensions and rising costs.
And capital investment, the traditional I component of GDP, also suffered significantly.
Outside of AI, it stalled completely. Firms delayed long-term decisions due to the utter unpredictability of their input costs and their supply chain stability. This massive break on non-AI investment, combined with the collapse of exports in Q1, was the first clear sign of the trade policy drag.
And this uncertainty directly connects back to the K-shaped economy we just discussed, specifically that frozen labor market that disadvantaged low-wage workers.
The impact on the labor market was arguably the most damaging structural consequence. The continuous threats of shifting tariffs created an environment where businesses, desperate to preserve capital and flexibility, just opted to wait rather than hire or expand their payrolls.
And that's when we saw job growth slow down.
It slowed drastically to only about 50,000 jobs per month. That's half the prior pace needed to absorb new workers. This directly contributed to the rising unemployment rate and the freeze that hurt lower wage and minority workers the hardest, ensuring the K-shape deepened.
So if we factor out the Q3 illusion and average in the Q1 contraction of the sustained drag, what's the consensus on the full-year cost of the tariffs?
The broader picture is highly negative. Most reputable estimates converge on a tangible 0.5 percentage point reduction in 2025 GDP growth, due explicitly to the trade barriers and the associated uncertainty.
So the economy would have been that much stronger without them.
Yes. The full-year growth is now estimated at a constrained 1.5 to 2.0%, which is a significant slowdown from the 2.5–3.0% pace we saw in 2024. Long-term projections are even more concerning, suggesting U.S. output could be 0.7% smaller permanently than it would have been without these trade wars.
And globally, the effects were massive, creating a headwind against our own exports.
That's the feedback loop. The IMF, for instance, estimated that U.S. tariffs alone shaved 0.5 percentage points off of global growth. This global weakness then feeds back into the U.S. economy via weaker demand for our exports. For instance, the research noted a significant 2.4-point hit to China's GDP from the full range of trade tensions, which reduces their demand for U.S. capital goods and agricultural products.
Let's delve deeper into the mechanisms of pain transmission. How exactly did these tariffs filter down to the everyday consumer and business?
The first and most critical mechanism is that tariffs function as a highly regressive tax. The analysis indicates that between 40% and 50% of the tariff costs were passed directly to U.S. consumers. They were not absorbed by foreign producers.
So this wasn't free revenue, it was a tax on consumption for Americans.
It was, and the immediate result on prices was a direct contribution to inflation, raising core inflation by approximately 0.5 percentage points for the year. And that inflation wasn't uniform. It hit specific necessary goods particularly hard. We saw outsized price increases in electronics, which spiked 18%. And also furniture, clothing, and essential auto parts, where tariffs on steel and aluminum filtered through the supply chain.
Can you translate that into household terms?
Right.
What was the annual burden for a typical family?
The data suggests this translated into a significant annual burden on U.S. households, ranging from $1,100 to $2,400, depending on their consumption basket.
And that's a regressive tax because it disproportionately hurts lower-income families.
It does, because they spend a larger proportion of their income on these necessity items like clothing and electronics. So the policy functioned less like industrial protection and more like a massive sales tax targeting essential items.
So yet another direct link back to the K-shaped economy. The wealth owners have the cushion of their stock portfolios to absorb that $2,400 cost, while the wage earner on the downward arm of the K is just crushed by the price spike, reinforcing the split.
It undeniably deepened the inequality. It raised the cost of basic goods while simultaneously freezing the labor market that determines low-end wages.
What was the second mechanism of pain?
Supply chain damage and the shrinking capital base. The massive reduction in imports, roughly $659 billion, wasn't just consumer goods. It was intermediate goods, raw materials, and capital equipment that U.S. businesses rely on to function.
And what's the consequence of cutting off that pipeline of foreign components?
It reduces the U.S. capital stock by an estimated 0.4%. That means businesses have less efficient machinery or fewer specialized components to work with. Economists associated the supply friction and reduced efficiency with roughly 503,000 job losses
Hmm.
before we even account for foreign retaliation.
And the retaliation was significant.
It compounded the damage, hitting $223 billion in U.S. exports, severely damaging key sectors like agriculture and targeted manufacturing exports.
There's a crucial point in the research about how the economic effects of tariffs evolve over time, from a demand shock to a supply shock.
hmm
Can you elaborate on that distinction for us?
In the short term, trade wars often look like a negative demand shock. They raise prices briefly, consumption drops, and unemployment might tick up. The hope is that this shock will drive production domestically.
But that's not what happens long term.
The analysis shows that over the long term, they become a permanent supply shock. By forcing businesses to use less efficient, more expensive domestic sourcing or reroute their supply chains, tariffs permanently constrain the economy's output potential. They raise long-term input costs and lead to permanently higher prices for consumers.
That's a dangerous combination. Constrained output and permanently higher prices. It's an expensive trade-off for the economy.
It is, and the sectoral impact was highly uneven. The winners were the capital-rich firms, predominantly the tech and AI companies, who were better able to absorb the rising input costs or simply pass them on, thanks to their high profit margins. The losers were the labor-intensive industries and, crucially, small businesses.
Why small businesses in particular?
Because they lack the legal and logistical resources to cope with the massive compliance burdens. They suffer from margin compression, and they had to resort to layoffs because they couldn't absorb the costs.
And what about the U.S. manufacturing sector that the tariffs were explicitly meant to help?
The data is complex. While there was some highly publicized selective reshoring firms moving a portion of production back to the U.S., the overall employment effects in manufacturing were negative.
How can that be?
It was driven by the higher input costs from steel and aluminum tariffs, combined with weaker global demand due to foreign retaliation. For most manufacturers, the drag on their business outweighed the selective benefit of protection.
So the ultimate synthesis of sections 1 and 4 is this. The spectacular 4.3% GDP surge in Q3 was built on a massive AI spending boom and a statistical illusion created by falling imports. A decline largely driven by the very trade policies that were simultaneously dragging down overall economic growth for the full year and deepening inequality.
That structural reality is why we call it a mirage. The tariffs promised protection, but they delivered friction, ensuring the machine ran hotter, slower, and less efficiently than it could have, while hiding its fundamental structural weaknesses behind a tech boom.
Let's pull the lens back now and look at the global implications. The analysis frames tariffs as economic gravity, pulling systems into new orbits. This fragmentation dramatically reshapes the fortunes of other countries, with vastly different results based on their economic structure.
Absolutely. The U.S. tariff expansion caused a global trade fragmentation, forcing a geopolitical and economic realignment. We can really categorize the global impact into three distinct archetypes, based on their response and their exposure to these changes.
Okay, let's start with the other advanced economies, like the European Union and Japan.
For these advanced economies, the story is largely one of generalized GDP drag. They share similar traits with the U.S., a high consumption share, complex supply chains, and a deep dependence on smooth global trade. For them, U.S. tariffs simply act as a new source of cost and uncertainty, hurting real incomes and corporate profitability.
So they just lose out.
Their net GDP impact is estimated to be negative, around 0.6 percentage points annually. Their sophisticated high-value exports, like precision machinery, high-end autos, and specialized chemicals, are highly vulnerable to retaliation, which further compounds the damage for them.
Okay, next, the export-led manufacturing economies, like China, South Korea, and Vietnam. These are the trade surplus economies that are deeply integrated into global value chains.
For them, tariffs act as an immediate and severe economic shock stress test. They face a sharp, short-term hit to their exports and employment, with estimated initial GDP losses ranging from 0.5 to 3.0 percentage points, depending on their exposure to U.S. consumer markets.
But these economies, especially China, don't just sit there and take it.
No. Economies like China have massive state capacity and highly coordinated industrial policy. They don't just absorb the shock, they adapt in the medium term through things like currency adjustments, aggressive market diversification, and domestic demand stimulation.
And finally, the third group, the emerging and developing economies. This includes countries like India, Mexico, and Indonesia.
Right. These economies have large domestic markets, high growth potential, and labor surpluses, But they also suffer from significant infrastructure and institutional gaps. They become the potential beneficiaries of trade diversion.
This is the China plus one strategy we hear so much about.
Exactly, where multinationals diversify production away from China to reduce geopolitical risk. This offers a potential tailwind, resulting in an estimated GDP boost of plus zero point 0.2 to plus 1.0 percentage points annually. But, and this is a huge but, this benefit is highly conditional on their ability to execute domestic reforms.
That brings us to the fascinating contrast between China and India, the two Asian giants, who reacted very differently being pulled into this new trade environment. Let's start with China, the primary target of the tariffs.
China faced the sharpest initial hit. The data suggests an estimated GDP loss of 2003 percentage points at the peak of the impact, which severely hit their electronics, footwear, and EV supply chains. Export margins were compressed, and major coastal manufacturing hubs experienced significant layoffs.
But the analysis argues that China didn't retreat. They used the tariffs as a forcing function to accelerate their pre-existing strategic goals autonomy and upgrading their economy.
That's the key strategic response. They saw the tariffs not just as a cost, but as an urgent signal of the need to re-engineer their growth model away from simple, low-margin assembly toward strategic autonomy.
So what was the first step in that pivot?
The first step was massive market diversification. They rapidly expanded exports to ASEAN nations, to Africa, and to Latin America. And they were successful, reducing the U.S. share of their total exports from around 19% in 2017 down to approximately 13%. They pivoted away from the U.S. as their primary customer.
And domestically, they accelerated their industrial upgrading push.
Absolutely. The state channeled vast resources, subsidies, and cheap credit into high-tech sectors, advanced semiconductors, batteries, solar panels, and industrial AI. They are prioritizing capacity building and technological self-sufficiency over simple export volume. The tariffs forced them to expedite the shift from being the world's factory for basic goods to becoming the world's factory for high-tech, strategic goods.
So the net outcome is deeply ironic. The tariffs hurt China's old export-dependent model. But in the long run, it may have strengthened their technological self-sufficiency and made their growth structure less vulnerable to external political shocks.
The outcome is slower, perhaps more controlled growth, but it's built on a far stronger, more autonomous technological base. It confirms that trade barriers are complex tools with highly unpredictable long-term consequences.
Now let's turn to India. They seem to have been an accidental winner in this scenario, benefiting from the ripples of trade diversion rather than being the direct target.
India benefited significantly from these geopolitical spillovers. The China plus one diversification strategy led to surging foreign direct investment, or FDI, in manufacturing. Major global OEMs like Apple and Samsung expanded their electronics assembly footprint there.
And this was amplified by India's own domestic policies.
It was. Specifically, their production-linked incentive, or PLI, schemes, which offered massive subsidies and tax breaks to firms that met specific production and export targets. They saw the opportunity and tried to seize it.
And this accidental benefit provided real, measurable momentum for the Indian economy.
The estimates suggest the GDP uplift from this trade diversion alone was between plus 0.3 and plus 0.7 percentage points annually. This is tangible momentum, particularly in electronics and auto components, which saw employment growth outpacing historical trends. Furthermore, India's large consumption-driven domestic market offers a valuable degree of insulation from global export shocks, which gives them a lot of resilience.
But the analysis strongly cautions that this benefit is conditional. India faces serious structural constraints that prevent it from fully realizing this potential.
That is the critical risk factor. Despite this massive opportunity, India faces binding internal hurdles. Rampant infrastructure bottlenecks, which make moving goods extremely expensive. Persistent regulatory uncertainty, which chills long-term investment. And critical skill mismatches in the labor force.
What's the most telling data point on that?
It's logistics costs. India's logistics costs are extremely high, around 13% to 14% of its GDP, compared to China's highly efficient 8%. That's a huge competitive disadvantage.
So if they don't fix those structural constraints, the infrastructure, the regulatory headaches, the high logistics costs, what's the long-term danger for India?
The warning is clear. Without deep, sustained structural reforms in governance, infrastructure, and logistics, India risks becoming merely a China-light assembler.
So just a low-value assembly hub.
Exactly. Rather than graduating to a full manufacturing powerhouse capable of driving innovation, complex production, and high-wage job creation. The trade diversion only opens the window. Internal policy execution determines whether they can actually fly through it.
This global comparison provides three key strategic takeaways about what tariffs really accomplish in a multipolar world.
First, tariffs primarily redistribute growth. They do not create it. They move value from one place to another, from the U.S. consumer to the U.S. Treasury, from China to India, but they destroy economic value in the process due to inefficiency and friction.
It's okay.
Second, large domestic markets, like the U.S. and China, absorb these shocks far better than smaller export-dependent economies. They can do that thanks to their massive domestic consumption bases and their state capacity to manage capital.
And the third, essential point, that policy quality is the true differentiator in the long run.
Absolutely. China used the tariffs as a forcing function to accelerate a strategic pivot that was already underway and well-resourced. India has an open window from trade diversion, but their ultimate success hinges entirely on whether they use this policy moment to address those deep structural weaknesses. The policy response is more important than the trade barrier itself.
So the real winners in this new, tariff-fragmented world are not specific countries, but specific capabilities.
That's the key takeaway for you, the listener. The ultimate winners are those who prioritize essential capabilities. Energy reliability, highly efficient logistics networks, advanced workforce skills, and predictable institutional execution. Tariffs are not impassable walls. They are costly detours. And the most successful economies are the ones that can effectively reroute their supply chains with the least amount of internal friction. So if we synthesize everything we've covered, we started with that astonishing 4.3% GDP number, a headline that just screamed resilience. But we quickly found its source in a single narrow AI boom, financed by venture capital and driven by hyperscaler capex. The economy is, quite literally, standing on GPUs, vertical, fast, and highly concentrated. We discovered its profound vulnerability in the serious risk of overconcentration and the potential for bubble dynamics. And this spectacular growth was simultaneously built upon pervasive drag of protectionist trade policy, which created the statistical illusion of the Q3 surge while masking the widening rift of the K-shaped economy, where wealth soared due to asset prices while labor stagnated due to policy uncertainty.
That is the ultimate connection for you, the listener. This deep dive showed you that macro headlines can be a mirage, a snapshot of speed that completely obscures structural failure. The apparent strength of consumer spending, the C component of GDP, was largely driven by wealth effects, asset owners spending freely due to stock market highs fueled by the AI boom. And this masked the underlying weakness in the labor market, that frozen downward arm of the K and the dramatic slowing of traditional capital investment. The economy was running hot, but participation was weak, and the policies designed to protect it were actually deepening the divide.
Which brings us to the crucial question for 2026 and beyond. The technical prediction is that the AI machine will continue to hum. Q4 growth is projected around 3%, continuing the trend. But the fundamental challenge is not speed, it's distribution and participation. Can AI productivity and the resulting wealth spill beyond the tech giants and the asset owners fast enough to truly pull the bottom arm of the K up? If the AI engine only serves the people who fund it, if the productivity gains merely lead to mass displacement without creating new opportunities, then the growth is structurally unsustainable.
The 4.3% surge may someday be remembered not as a moment of triumph, but as a warning light, blinking brightly just before the road curves sharply. We've seen that growth built on barriers and policy-induced uncertainty is inherently brittle, while growth built on broad participation and structural efficiency is durable. The challenge for policymakers now is immense. How quickly can they turn the current economic detours, the tariffs, the growing inequality, back into a shared road for all participants?